Welcome to the Mental Health Market Update, where we talk about what's happening in the mental health industry. Here's your host, Stephen Hayes.
On this week's Market Update, we investigate whether or not telehealth is here to stay, and what does CATASYS earnings mean for behavioral health startups. Morgan Stanley polled a group of healthcare innovators about when they thought telemedicine visits would go from the current low single digits to 25% of patient interactions. This was pre-COVID, mind you. Of that group, which included CEOs of digital health companies and big tech executives, retail, investors in digital health companies, etc., 19% of those polled said that they think a 25% penetration of telehealth was 2 to 3 years out still. This is in February of this year. 2/3 of those people said it would be 5 years out. And then the world changed a month later. And according to IMS Health data from an April 10th survey, over 50% of clinicians reported using telehealth. This number was in the single digits. That's a drastic shift from in-person to telehealth, and obviously driven by COVID, obviously driven by necessity. But what gives? Why is this happening? And is it going to stay? Will things go back to normal? Will there only be 5% telemedicine in 3 months, 6 months, whenever the normal or new normal happens to be? So what gives? Why is this happening? I mean, it's obviously COVID, right? But what does it mean? And will this stay when things go back to quote unquote normal, whatever that means? According to that same Morgan Stanley report, they did an interview with Dr. Arthur Klein at Mount Sinai in New York. After this pandemic is over, he expects some amount of previously in-hospital care volume to shift to telehealth and virtual care. I don't disagree, and the companies I'm talking to seem to say the same thing, but the question's how much? How much total care will be provided virtually after things go back to quote-unquote new normal? Nobody knows. For my conversations with CEOs who operate in businesses with some mix of virtual and physical healthcare services, I've been hearing that their virtual business was a low single-digit percentage of their business before COVID, just like the report I mentioned indicated. Now it's 100% virtual by necessity. But these CEOs that I've talked to said that they believe it could be a 20 to 25% virtual or telehealth mix in the new normal. Time will tell, but that's a pretty consistent answer that I've been getting. So what does that mean? Healthcare is evolving. It's evolving at the fastest pace that it's ever evolved before. Regulations are changing, public perception, doctors' preferences, technological capability, reimbursement rules, and rates. They're all changing drastically. The door's wide open to innovate and disrupt in the digital health space, including around our market, which is the mental health space. According to IQV data, pre-COVID telehealth was used dominantly by the mental health industry. But in the week of March 27th, that data shows that top telehealth diagnoses address chronic asymptomatic conditions, including diabetes, hypertension, and cholesterol. This shift to telehealth by traditional physical care providers further destigmatizes and normalizes the remote care model in both the mind of the patients and providers broadly, as well as payers. Telehealth is just one of the many major themes we're tracking in the space right now. A lot's happened. A lot's changed because it's had to. Regulation has changed drastically. We've never seen CMS move this fast, be this flexible. We've never seen the FDA move this fast. These new regulations could really accelerate new business models and pave the way for startups and tech entrants to accelerate anything from clinical trials to new care delivery to capacity increases in the system. Telemedicine and digital health, we just talked about, will be more of a permanent fixture. We're democratizing resources. So hospitals are being forced to work together and share medical resources, making beds available across systems and platforms. State coalitions have formed on the coast to coordinate care and policy as the economy reopens. There's a lot of long-term implications from COVID that I think could lead to a change in the way demand exists and the elasticity of that demand for healthcare services. Secondly, this week, I've been very focused on CATASYS earnings. CATASYS earnings were reported yesterday, Thursday afternoon after market close, with a miss versus expectations on EPS. They beat on revenue by $270,000 with total quarterly revenue of $12.34 million, which is up 81.5% year over year. The company reiterated its 2020 revenue guidance of $90 million. Look, I love it when companies reiterate guidance in the face of a volatile market. It's extreme confidence. one quarter into the year, and they've got the balance of the year ahead of them. They could have easily hidden behind a volatile market, punted and lowered guidance and blamed COVID. That confidence is incredible. Stock traded up 13% yesterday into these earnings, so go figure. Equity traders love confidence, but that's another mental health conversation for another day. But what does this mean? Why am I interested in CATASYS as an investor in mental health startups? I follow CATASYS closely for a number of reasons. CATASYS helps healthcare payers reduce costs and improve care among the most expensive and difficult to manage patients in their populations. Those patients, as you may have guessed, they are folks with both chronic medical conditions and behavioral health conditions. CATASYS combines predictive analytics and human interaction to get this job done. On the predictive analytics side, the company uses data from multiple sources, such as claims, third parties, its own on-track system to identify which health plan members are not getting the proper behavioral health care they need. Once identified on the human interaction side, a CATASYS team member reaches out and engages with an individual on the plan and pairs them up with a care coach who then helps establish a tailored treatment plan for their behavioral health needs. Once CATASYS signs an agreement with the plan provider, they use their AI to predict which patients are the best fit for the on-track system and then reach out and onboard those patients. People who are eligible for the CATASYS program cost insurance companies about $30,000 per year in medical costs. It's a pretty high PMPM. Once CATASYS enrolls one of those members into the on-track system, they make $8,500 for the year to manage that patient. CATASYS has shown the ability to reduce payer spend on this population with the comorbid population, mental health and physical health, by about $16,000 per year. That means they're taking the average cost for the insurance company from $30,000 down to $14,000 per year, including the $8,500 they have to pay to CATASYS. That's well over a 50% reduction in cost to the payer. I've heard one other private company in this market that does about a 30% reduction on average, and they've raised a ton of money at a high valuation. So obviously, if you can walk into an insurance company and you can drop their overall patient population cost by some large number, which to an insurance company, 2 or 3% of cost reduction is a large number. If you can drop their cost down 30, 50%, you can do something really special. So why do I care, and why should you care if you're a startup or an investor in the behavioral space? Look, it's another data point. Last week, we talked about Able2 getting 10x revenue in their sale to Optum. And now we're talking about the valuation of a behavioral health company in the public market the day after earnings in a very tough market. It's another valuation data point. And we'll get into those numbers in just a minute. If you listen carefully to how I describe their business plan and what they do to make money and how they add value to the payer, it's very clear. They have a very similar business model to many behavioral health startups, including those who have just raised a lot of money at steep valuations. CATASYS is going out and treating hard to reach, hard to engage patients who are typically very expensive for payers. This effort is resulting in another proof point of how important behavioral health care is for our system, our providers, and our payers to pay attention to and to treat just as importantly, if not more importantly, than physical health care. As society, our industry, payers, providers, and people start to understand this, you're going to start seeing companies like CATASYS continue to enjoy explosive growth. They're helping a lot of people. They can help a lot of people and do it in a lot more cost-effective way than some other treatment solutions, maybe far better and more effectively and cheaper than going to rehab. So why is CATASYS a great bellwether for the behavioral space? Well, they're growing like a startup. They're doubling revenue this year. They're supposed to double revenue, far more than double revenue next year. And this continues out for a couple of years. This high growth plus their focus on behavioral solutions and negative cash flow make it look like a startup, or at least a lot more like a startup than most public companies. So that makes CATASYS a great comp for private behavioral health companies, in my opinion. So what's interesting to me is that they actually trade at a discount to their peers, which I kind of call the healthcare IT SaaS peers. And as of last night, after earnings, CATASYS is trading at about 5.5 times 2020 forward revenue, while their peers are trading about 7.5 times 2020 forward revenue. Why the discount? What does that mean for a founder? Let's say you have a behavioral health startup and you just did $1 million in revenue last year. You're projecting $4 million in revenue this year. You're growing like crazy, faster than CATASYS, which makes sense because you're earlier stage. You're negative cash flow, just like CATASYS, and maybe you have less customer concentration, which theirs is really high. They have a lot of concentration in their top 30 to 50% of their revenue. But you're less financially stable when it comes to runway. I mean, look, they have the capital markets they have access to, and they have a revolver in place. So they're a more stable company than a seed stage or Series A startup that raised a few $1 million and is trying to figure out how to hit a metric or milestone to be able to raise that next round. Let's say you're going to go out and raise $3 million, and and you're selling 20% of your company, which is, call it average. That implies that your valuation is going to be about 15 million or in that ballpark for this round. If you take the CATASYS multiple of 5x forward and apply that to your 4 million of revenue, that gives you a $20 million valuation. Okay, well, that triangulates to the 15 million implied by how much of the company you're selling. I doubt investors are going to give you that unless you can mitigate more risk than CATASYS and show more upside. I believe you could show more upside, but it's because of your scale, and your scale is a risk factor. So without capital market access and a revolver and all of that liquidity that CATASYS has access to, as well as research analyst validation of your forecast, I doubt you're going to get 5x forward multiple on your fundraise. It's worth striving for. You can start the conversation there. You can maybe see if a dumb money investor is willing to give it to you. But even if they do, you're setting yourself up for failure in future rounds. So I'm not sure it's worth striving for that valuation, but it's worth considering. It's worth considering that maybe the market's telling you your forecast is off, and a self-aware, intelligent founder should ask that question. What is the market telling me when I'm not getting the valuation I want? So that's it for this week's Mental Health Market Update. Grateful to have you here. Thank you for listening. If you like our content, please give us a like, a subscribe, follow, a review on your podcast platform of choice. We hope that you will stick around and listen to more of our content, and we'll be back next week. Thanks.